Gold is the oldest monetary asset in human history, and it is currently being repriced by the newest class of institutional capital. Most retail investors have not noticed the shift. The conventional framework for gold allocations is well established. You hold 5 to 10% of a portfolio in gold as a defensive instrument, a countercyclical hedge that appreciates during risk-off environments and produces no yield while it waits. This is the textbook allocation. It is also increasingly disconnected from how gold is actually behaving in the current monetary environment. Gold held near multi-decade nominal highs through a period of the most aggressive rate hiking cycle in 4 decades. The standard model predicts that elevated nominal rates should produce sustained headwinds for a non-yielding asset. The data did not cooperate. Gold absorbed a rate environment that historically would have pressured it significantly, and in many periods advanced through it. The dislocation is visible. The relationship between real yields and gold prices, one of the most historically reliable correlations in macro analysis, has weakened materially. When a foundational correlation breaks down, it is not an anomaly to be dismissed. It is a signal that the underlying incentive structure has changed. Something structural is being repriced. The question is what, and what it implies for how a rational actor allocates to gold in this environment. The macro forces driving gold's structural repricing are not mysterious. They are the same forces reshaping the entire capital stack, and understanding them in sequence clarifies why the textbook gold model is no longer sufficient. The first macro force is the real yield regime. Real yields, nominal interest rates adjusted for realized inflation, determine the true cost of holding gold. When real yields are deeply negative, the opportunity cost of holding a non-yielding asset compresses. Cash and bonds are losing purchasing power in real terms, so the absence of a coupon on gold is no longer a meaningful disadvantage. The post-Minus 2022 rate cycle pushed nominal yields higher, but the inflation environment simultaneously elevated the denominator of the real yield calculation. For extended periods, real rates remained lower than the nominal rate environment suggested. That partially explains gold's resilience. The complete normalization of real rates into durably positive territory has been consistently deferred, and that deferral is itself a signal about the structural constraints on monetary tightening. The second macro force is sovereign debt dynamics and fiscal dominance. Global sovereign debt burdens expanded significantly during the 2020 to 2022 fiscal response period. The refinancing requirement for this debt, rolling it over at materially higher nominal rates, creates sustained upward pressure on government borrowing costs. When debt service consumes an expanding share of fiscal revenue, the institutional pressure to keep real rates below nominal growth rates intensifies. Financial repression is not a new mechanism. It was the dominant monetary management tool in the post-World War II period from roughly 1945 to 1980. During that period, gold significantly outperformed in real terms, once the price controls of the Bretton Woods era were removed. Observation: sovereign debt burdens are historically elevated across major economies. Interpretation: the structural incentive favors sustained financial repression, real rates held below the level that market forces would otherwise set. Probabilistic implication: the environment that has historically produced gold's strongest multi-year performance, negative or near zero real rates in a high nominal debt environment, is not a temporary condition. It is structurally embedded in the fiscal mathematics of the current cycle. The third macro force is central bank reserve diversification. The dollar's share of global foreign exchange reserves has declined gradually but persistently over multiple decades. The acceleration of this trend following the freezing of Russian sovereign reserves in 2022 created a documented inflection point in how reserve managers assess concentration risk in dollar-denominated assets. Gold as a reserve asset with no counterparty, no issuer, no sanction risk, no credit risk, became structurally more attractive to central banks managing geopolitical exposure. Central bank gold purchases reached multi-decade highs in the years following 2022. Gold is no longer functioning primarily as a risk-off hedge within a dollar-centric monetary system. It is functioning as a hedge against the system itself, against the long-run reliability of that system to preserve real purchasing power and geopolitical neutrality. That is a category change in the asset's role. and it demands a category change in how portfolios account for it. The behavioral evidence at the institutional level confirms the structural shift identified in the macro analysis. Rational actors with large mandates are not allocating to gold the way the textbook prescribes. The first observable positioning signal is central bank accumulation at scale. Central banks across emerging market economies, China, India, Poland, Turkey, and the Gulf Cooperation Council, have documented multi-year gold buying programs that have materially expanded their reserve positions. The incentive is structural, not speculative. These institutions are not buying gold because they expect short-term price appreciation. They are buying gold because it is the only reserve asset that carries no issuer counterparty risk, no payment system dependency, and no jurisdictional exposure. When the largest, most risk-averse, longest duration capital allocators in the world are systematically adding to a position, the structural demand signal is meaningful regardless of their stated motivation. Observation: central bank gold purchases reached multi-decade highs in the years following the 2022 sanctions event. Interpretation: sovereign reserve managers are structurally diversifying away from concentrated dollar exposure, using gold as the primary alternative. Probabilistic implication: this demand is structurally durable. It is not momentum-driven, and it will not reverse based on short-term price volatility. The second observable positioning signal is the growth of physically backed gold ETFs and the changing composition of their investor base. Gold ETFs have experienced demand patterns that reflect both retail and institutional participation. Hedge funds, family offices, and sovereign wealth vehicles have used gold ETF exposure as a component of macro positioning frameworks, not purely as a crisis hedge, but as a structural component of portfolios designed to navigate monetary uncertainty over multi-year horizons. The third observable positioning signal is the gold to Bitcoin ratio and the institutional sequencing of hard asset adoption. A structural question has emerged: are gold and Bitcoin competing for the same allocation, or are they serving distinct structural functions? The observable behavior of institutional capital suggests the latter. Central banks and long-duration sovereign funds have not adopted Bitcoin. Their mandates, regulatory frameworks, and risk parameters preclude it. Financial institutions and corporate treasuries, by contrast, have shown interest in Bitcoin as a higher volatility, higher convexity complement to gold, rather than a replacement. These are not competing allocations. They are complementary layers within a structured hard asset framework. The derivatives and behavioral layers of the gold market provide additional texture on where structural pressure is concentrated and where the risk asymmetry resides. The first derivative signal is the gold futures basis, the spread between spot gold prices and futures contract prices at various maturities. Under normal market conditions, gold futures trade at a premium to spot that reflects the cost of carry. Financing cost minus lease rate. When this basis compresses or inverts, when futures trade at a discount to spot, a condition known as backwardation, it signals acute near-term physical demand that is not being satisfied by paper market supply. Backwardation in gold is a structurally rare event. Its occurrence has historically marked periods of significant supply stress and subsequent price appreciation. Monitoring the basis structure provides early warning of physical market tightness not yet visible in spot price behavior. The second derivative signal is open interest dynamics in COMEX gold futures relative to reported warehouse stocks. When open interest, the total number of outstanding futures contracts, rises relative to the physical inventory available for delivery, it creates structural pressure on the settlement mechanism. A rising ratio of paper claims to physical supply is not a stable equilibrium. It resolves either through price adjustment that draws additional supply into the delivery process, or through cash settlement that relieves delivery pressure without resolving the underlying physical supply dynamic. Tracking this ratio over time provides insight into the structural tension between the paper gold market and the physical gold market, a tension that has historically resolved in favor of the physical price signal. The first behavioral signal is gold's directional behavior during equity market drawdowns. Gold's countercyclical properties are structurally documented across multiple historical cycles, including the 2000 to 2002 technology bear market, the 2008 financial crisis, and the 2020 pandemic shock. In each case, gold's correlation to equities declined or turned negative during the period of maximum equity stress, providing genuine portfolio diversification at the moment it was most needed. This behavioral pattern reflects gold's role as a liquidity reserve for institutional portfolios. When risk assets are being sold to meet redemptions or margin calls, gold, which retains its value and liquidity, is sold last. Or not at all. The second behavioral signal is the flow behavior of retail versus institutional capital into gold during different market regimes. Retail capital tends to flow into gold reactively after a visible crisis has materialized and gold has already appreciated significantly. Institutional capital tends to position in gold proactively during periods of macro uncertainty before a crisis resolves into a directional market move. This behavioral asymmetry means that the periods during which retail investors are underallocated to gold, typically during extended risk-on rallies, are precisely the periods during which institutional capital is quietly building structural positions. The convexity insight is straightforward. The expected value of a gold allocation is highest when the narrative case for holding gold is weakest, because that is when structural buyers are accumulating and structural sellers are absent. The structural analysis above does not prescribe a specific allocation size. It prescribes a framework for thinking about what gold is actually doing in a portfolio, and whether the role it is being asked to play matches the structure of the monetary environment. The first positioning principle is distinguishing between gold's tactical and structural functions. Tactically, gold functions as a risk-off hedge, appreciating during acute financial stress and providing liquidity when other assets are illiquid or declining. Structurally, gold functions as a monetary debasement hedge, preserving real purchasing power over long-time horizons in environments where sovereign currency supply is expanding faster than economic output. These two functions are related, but not identical. A portfolio that holds gold only for its tactical function will systematically underweight it during the extended periods of apparent calm that precede monetary regime shifts. A portfolio that holds gold for its structural function sizes the allocation based on the long-run monetary environment, not on near-term volatility signals. The second positioning principle is understanding gold's relationship to real yields as a dynamic input, not a static one. The historical correlation between gold and real yields remains analytically useful, but its predictive power is conditional on the monetary regime. In periods of financial repression, where real yields are managed below their market clearing level, gold's sensitivity to nominal rate changes is reduced because the real yield signal is being suppressed by policy. In periods of genuine monetary tightening, where real yields are rising because inflation is being durably contained, gold faces genuine headwinds. Distinguishing between these two regimes in real time requires monitoring not just the nominal rate environment, but the fiscal context that constrains how far real rates can actually rise. The third positioning principle is recognizing where gold sits within the broader hard asset spectrum. Gold occupies the low volatility, high liquidity end of the hard asset allocation. It carries realized volatility meaningfully lower than Bitcoin, lower than most commodities, and comparable to investment-grade bonds in certain market regimes. This volatility profile makes it the appropriate hard asset for portions of a portfolio where drawdown constraints are binding. Institutional mandates, liability matching frameworks, and capital reserves where a 50% drawdown is structurally unacceptable, regardless of long-run expected value. That is gold's domain. Bitcoin occupies the high volatility, high convexity end of the same spectrum, appropriate for the portion of the portfolio where the drawdown can be absorbed in exchange for asymmetric upside. These are not competing allocations. They are complementary layers within a structured hard asset framework. The fourth positioning principle is mean reversion discipline. Gold has experienced multi-year periods of significant nominal underperformance relative to equities, most notably the 1980 to 2000 period following the inflation shock of the 1970s. In each such period, the structural case for gold did not disappear. The monetary environment temporarily shifted in a direction that reduced gold's relative attractiveness. Investors who exited gold allocations during these underperformance cycles, on the assumption that the structural case had resolved, consistently missed the subsequent revaluation. The discipline is in understanding the structural thesis clearly enough to hold through narrative deterioration, which is precisely when the expected value of the position is being rebuilt by institutional accumulation at lower prices. The monetary environment will not remain static. Real yield dynamics will shift, fiscal pressures will evolve, reserve diversification trends will continue or accelerate. Gold's role in a rational portfolio is not fixed. It is a function of the monetary architecture and the structural position of the portfolio within it. Understanding that architecture clearly is the prerequisite for allocating to it deliberately. 21 Protocol, Capital Intelligence, Strategic